Hello, it is Wednesday night, March 18th, 2020, and the stock market was down a lot today on the coronavirus crash. I'm doing a little update here because, as you have seen in the past few days, I have started to get you ready to start buying stock again. And I don't know that that is going to happen in the next day or two. It might. I'm thinking that Friday morning could be a pretty good morning to buy because I believe that there will be a stimulus package that is huge. For lack of a better word, it'll be huge. And if they do it right, it should bail out the economy from the ground up. If they do it wrong, it'll be just like the financial crisis where a lot of people get left behind. But the stock market probably does okay. So I don't want to dwell on too many things here. We're going to walk right through this. But first, I'd like you to think about where you have been, certain major turning points in the world. And I would think that you should start thinking about the internet when you think about turning points. The internet changed a lot of things for a lot of people, for a lot of businesses. It encouraged interaction, communication, bad communication, but it really did change the flow of information, and it changed the markets. 9/11, I remember getting out of the shower and listening to Bob and Brian on the radio here in Milwaukee, and Steve Zabin was the guest, and he broke into the kidding around and said, "Guys, turn on the TV." An airplane just hit the World Trade Center. I remember the Friday before the 2008 crash when all of the people on CNBC had pale faces, and I started selling what I had left in the stock market then. I had already gone very, very equity free, and it turned out some of my bonds got killed too. So if it had not been for the bonds getting beat up, I actually wouldn't have lost any money during the financial crisis because I was net short equities. Right now, I think we're all going to remember where we are because we're all pretty much at home. Coronavirus has sent a chill through a lot of people's lives. It is spreading rapidly in the United States, and it's sure to kill thousands of people. Now, there's a lot of bad information about coronavirus. I encourage you to go to the WHO website or the CDC website for updates. What you're going to end up finding is that because we're not doing testing as well as we should, that we're underreporting the cases. As people die or hospitalized, we start to get the point of what's going on. For lack of a better term, what the coronavirus COVID-19 is a super flu that causes pneumonia. And for people who already have immune systems, respiratory systems that are at risk, older people, people on COPD, people with other conditions, the death rate is very high. Younger, healthier people tend to not be affected as much, and some of them are having very, very bad attitudes about trying to avoid the virus. They think, many of them, that because it may not hurt me or probably won't hurt me, I'm just going to go about living my life. I saw some pictures of big time parties going on in Florida on the beaches and around there. Frankly, I think every one of them needs a kick in the ass, punch in the face, slap in the head, that sort of thing. As this spreads, we are likely to see the economy tank even further because fewer and fewer people are going to be at work. Again, I do think the government's going to come to the rescue, and there's going to be good and bad consequences. Just like in the financial crisis, the way that they did things, pouring money on top, caused asset inflation and greater wealth inequality. So I'm hoping that we do it a little bit differently than we did it in 2008, because that was a very mediocre response. The economy hasn't grown fast since then. We've averaged about 2% GDP growth, and our debt has grown more than the economy has. And I think you should think about that. In the last 11 years, the debt of the United States has grown more than the economy has. That's not a good formula. You're supposed to get a return on your money. So in my 2020 outlook, I talked about how we go from euphoria to despair. And I pointed out different things that I thought mattered. Key among those were valuations, political uncertainty, a cyclical slowdown in the economy, and I speculated on some sort of an early year volatility event. Now, I did not know that this would be the volatility event. However, on about January 22nd, I had been getting some Twitter feed stuff about the virus in China. And when it finally hit CNN, I posted on Twitter, and you can go check my feed, it's there, that it was the most important story in the world at the end of January. By February 7th, I was telling people, I really think you should get to 75% in cash. And that was something that I had intended to do and thought maybe do it a little bit later. By the week before the crash, I did a webinar and I told everybody, hey, this is going to hit hard. And I went through all the different things that I expected in these different articles. I'm not going to go through them all, but I think that you should read them. This is one of the things that I pointed out. This is a Twitter conversation over 2 years ago, with Mark Yusko. And way back then, he thought we were at the euphoric, delusional phase of the market and we're ready for a bear market. I said, no, I think we're just around enthusiasm. And he said, well into delusion 2.5 years ago. This guy's a big deal. And he was very wrong. He's really wrong about Bitcoin, too. So I told him, I'll bet you a nickel, maybe even a dime, that we get a 9 to 19% correction. And then by 2019, SPY hits 300. Too much funny might make people giddy yet. And what happened? We saw the stock market rise. So about here, he's telling me we're in euphoria. But the market kept rising. We got a couple of corrections, 10%, actually 9.9% and 19.9%, if I remember correctly. We made a lot of money, subscribers of this service, on that first volatility event. The other volatility events weren't as easy to see. The current one is even bigger. I said all along that we would go down to this level on the stock market. And this is right where we are now. I said if we have a financial crisis, we go down here, 16, 17, 1800 on the Dow. The S&P 500. I don't know that that'll happen because I think the stimulus, the rescue will come soon enough. But if they dilly-dally in Congress, if Mitch McConnell, who I think is one of the biggest moron, corrupt senators to ever live, screws this up and focuses on tax breaks instead of getting money to the middle class and those who need it, then we will have a financial crisis. So we'll find out, and I think we're going to find out in the next week or two which way things are going. I don't think Nancy Pelosi is going to let that happen. I think she's basically going to hold the Republicans hostage until she gets the deal that she wants, which I believe will be a bottom-up approach and a middle-out approach. And I think that that would work better. It would have worked better in 2008 and 2009. We wouldn't have had the wealth inequality that we had, and the markets probably would have done even better because then we would have had actual organic growth. So when we take a look at these charts, I want you to think about what we're looking at. This M means monthly. This gets measured at the end of each month. You can see the relative strength index is down, getting towards 30. And at the end of the month, it'll be at or below 30, which means that on the very long-term chart, the stock market will be oversold. Whenever that happens, it's typically a great buying opportunity. Right here. Right here. And we're about to get the third one in 20 years. This is going to be a very good buying opportunity. But you don't want to buy the S&P 500. For all the millennials out there who are claiming to be in the FIRE movement, controlling their budgets and saving as much money as they could, as young as they could, so they could retire at 40 years old, if you invest in the S&P 500, you're going to be very, very disappointed. This index is damaged, and it's not going to recover. In fact, by the end of the decade, I think we have another crisis having to do with the retirement systems on the planet and in this country, such that the S&P 500 collapses again. So between now and the end of the decade, you have some choices to make, and you're going to have to do some trading. You don't have to day trade, you don't even have to swing trade, but you're going to need to position trade. And position trades mean that every 6 months to a couple of years, you make a fairly significant asset allocation change. If you don't make those changes, a choppy market by the end of a decade could equate to a 1 or 2, 3% return for you if you did nothing. But if you trim near the tops and you add back in at the bottoms, you're going to do very well. In fact, you may triple, quadruple, quintuple the market return. For those of you who got to 75% cash before this all started, you're doing pretty good. And you're waiting for an opportunity to buy. I know that people are getting clicker fingers are getting anxious. They want to click, 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 and buy stuff. Use these charts the way we've been talking about. On the weekly, we know we're oversold. Okay, money flow is about to go negative, and on the monthly, it's going to go negative as well. That means more money, way more money coming out of the market than going in. Momentum is straight down. Look at that blue line, straight down. I should make that red. Doesn't much matter. I just want the line to be thicker. Yeah, they don't want to make it thicker. There we go. That's a pretty steep line down. Daily doesn't matter, you're not day traders. And if you were day traders, you'd use hours or minutes. So as this comes down, it gets back down here. This gets down here. We back this up and we say, okay, what did it look like in 2008? What did it look like in 2000, 2001? Now, I believe that the speed of this drop is going to be, it's a record, how fast this dropped. And how fast we come out of it. The difference was back in here, we really didn't have any stimulus. We got mediocre stimulus. And I think we're going to get the mother of all stimulus here, and I think they're going to do it mostly right. But the problem with the S&P 500, and we've showed this before, is that over 100 companies, what I have 2 years ago called grandpa stocks, are going to die, right? So by the time the S&P 500 dumps those stocks and adds new growing companies, it'll be too late. And what we know is that there's a different index that beats the hell out of the S&P 500. and that's the triple Qs. So there's a couple things that we can think about here. If we know that the S&P 500 has between 100 and 150 stocks that are going to lose half of their value or more, with dozens and dozens of bankruptcies, just think about the oil and gas companies, which we'll visit here in a minute. Isn't there a better index? Isn't there one where the companies are basically all profitable in parts of the economy that are doing well? Well, there is. And that's the Invesco QQQ. It's 100 stocks. It's your Apple, Microsoft, Google, Amazon, Netflix, Pepsi, Biogen, Amgen, Comcast. Go right down the list. Almost every stock is a good company. The stocks in this trust, in this ETF, have about 70% of all the cash in America on corporate balance sheets. So of roughly 5,000 publicly traded companies now, maybe it's a little less now, I don't even keep track of that anymore, of the thousands of companies in America that are on stock exchanges, these 100 have 70% of all the money. And they have higher profit margins pretty much across the board. Pretty simple equation. If you want to index invest, if you want a core investment, this is the one. This is the blue chip economy of the next decade, and really it has been of the last decade as well. We're getting to the support levels on here at about 150. There you go. At about 150, right? We're at 176 right now. We were in a pretty significant support zone. At about 130, which marks the peak from 2000, we're at another level. And what I want to do is focus on this 2015-16 area, where it got really flat. We're going to talk about some things that happened in there. I believed back at the end of 2015 that we were likely to go into a recession. And then a couple of things happened. The first thing that happened is that oil crashed. And that was like a jolt of positive news to the economy. Not only were we creating jobs because of the shale boom, even though there was a bad year in there, but oil got very cheap, and that was good for everybody. And then President Trump got elected, and he started deficit spending by $1 trillion a year and handing out tax breaks to the rich, which was bad for the wealth equality, but it pushed the stock market up. But it was an artificial high, basically a sugar high. It's now all gone. There is no more Trump rally. It's gone. And it probably was going to be gone by the end of the year anyway. If you go back and read this article, I believed that because I thought President Trump was going to lose, that people would sell to lock in their gains. The very rich would lock in their taxes. I believe that they were the first ones to sell when this news hit. And now, in the last week, we've been starting to see panic. I know there's still a lot of people out there, middle class, people who look at their investments here and there, and then because they're going up, they don't act very fast. Why? Because they don't really know why the market's going up in the first place. They didn't know that we were on a sugar high. They didn't know that this was all relatively artificial the last few years. So they don't sell. They'll be the last people to sell. And if you're in that group, I would tell you at this point, don't bother. At this point, if you haven't sold, don't bother with selling. Think about rotating into better parts of the economy. The parts of the economy that have growth. That's your technology. That is your biotech. That's certain services, delivery, logistics, things along those lines. I believe I put the chart that you should be aware of in one of these articles. where I wanted to rotate to. It's around, I promise. There you go. Here's our ETF buy list. 5 ETFs. I'll give you all 5 of them. If you're not a subscriber, I'll help you find the spots. These 5 ETFs, QQQ, which is the index we just talked about, ARC, well, it should only be 2 Ks there, the Innovation Fund, Solar, Semiconductors, and Gold, which is a buy right now. But all of these are getting close to buy points, I think, before the end of April, and quite possibly by Friday. Did this webinar, and you can see this chart right here. These are the parts of the economy that are growing the fastest. IoT, cloud, artificial intelligence, robotics, machine learning, the space race. If you haven't been paying attention to what's going on in space, you're missing it. Some of these companies are going to grow very fast. 3D printing, DNA sequencing, immunotherapy, genome editing, cars, electric vehicles in particular, solar and energy storage. When I was in Vegas in January for the Consumer Electronics Show, 2 different executives said the exact same thing in different panel discussions. Sort of blew my mind. The perfect marriage right now is 5G technology, 5G communications, with the Internet of Things, IoT, and artificial intelligence. Why? Because we're going to have devices that talk to each other now that they have reliable and fast communication ability. 5G is so much faster than what we have for internet now that there's no latency between a computer up in the cloud talking to your car or to your phone. There's no time lag. You don't have that half a second or a second. And if you're in a car, that makes a big difference because you're covering a lot of ground quick. So where we want to be invested is not only in the big companies that are in these fields, like in QQQ, but in the mid-sized companies, like over here in ARC. And there's a couple of other funds. You could substitute them out. This one's actively managed, and I like that it's actively managed. So, oh, look at that. They want me to play poker. Have to turn that off temporarily. So what I would suggest to you is you take a look at ARC if you haven't. And again, we have some substitutions if you want a non-managed fund. TAN is solar. We've talked about this over and over again, what we want to get into. Semiconductors are the brains behind the internet. And again, I'm not going to show these charts over and over again that I've showed before. But if you just go through this article, which is, if you're not a subscriber, take a free trial, steal the stuff, I don't care. I don't want you all to lose money because you didn't want to pay $199 for a year. And that's all it's going to cost you. So I would, trying to close that off. I would take a look at a free trial right now to margin of safety investing, or you can go to fundamental trends for half price. If you just get the free library card, you'll get another discount code in the next day or two. Smart 50 gets you anything for half price. The Vanek gold miners I want to talk about though. I'll specifically talk about that one. I believe there's a massive bull market in gold and gold stocks about to start, and I think the gold stocks will do better. Why? Because as the price of gold goes from where it is now, 1,400 up to probably 3,000 by the end of the decade, we have to remember that it costs about $1,000 to get an ounce of gold out of the ground. So as the price goes up, the gold stocks are leveraged to that. So you get leverage owning the stock versus the commodity. You don't have to buy options. You don't have to do anything exotic. To get the same leverage, you'd have to use futures with gold. And that's very risky because you're on margin. If you just buy the top gold stocks, you're probably going to do very well. This ETF is hanging around $20 a share right now, and I would suggest that you own some of it. The old wisdom is 5% of your portfolio in gold. That's what I was told until the tech boom. And then it was like, you don't need gold. And as soon as they told us that, gold went up 600%, and the tech bust occurred. So you typically want to be a contrarian on these things. Back in 2012, I wrote an article telling everybody to get the heck out of gold. It wasn't going to lead anymore. And it plunged over 40% in the next 3 years. This is where I told people to get in. Way over here in 2000 is where I told people to get out. And in the last year, I've been telling people to start buying gold, and it started to come back up. This sell-off is your opportunity to get in there. I think you should have between 8 and 12% of your money in this gold ETF. You could buy the individual stocks, but core to the strategy right now is just focus on these 5 funds, get fully invested in the next 2 days to 2 months. I just don't know how far the panic will go. That's why we look at the technical indicators. The last time in 2008, I bought the day after the bottom. And in 2018, when the stock market crashed, I bought on Christmas Eve, and that was the bottom. So we can get pretty close on picking these bottoms because you finally have this one huge capitulation day. We haven't seen that yet. If you've been listening to the webinars for the last several months, I've told you pretty much on almost every webinar that we'd see days where the market was down 2,500 and it would open limit down. In the last 2 weeks, you've learned what limit down means, right? So we'll probably have a day where we hit the circuit breakers twice. And then shortly after that, the market will rebound in an afternoon within days. So the day we're looking for to signal the worst is over will be the day that we hit the circuit breakers twice. That would probably be, I don't have to take a look right now, about 3,000 point down day again. So we'd have to break the record that we just set because now we're working from a lower level. When 700 point swings become normal again, instead of 1,000 and 2,000 and 3,000 point swings, that's when you know things are getting better. There is speculation because the European Commission, the European Central Bank, just decided to go and do what our Federal Reserve has been doing, print a lot of money. The market futures are up about 0.5%, maybe 1% right now. I would guess that by the morning, those futures are lower, and I hope that they are. I hope that tomorrow the stock market is down 3,500 points. And if it is, you need to be ready to buy maybe the next day. If the market chops along and trades up and down for another week or two, which is entirely possible, you just have to keep your clicker finger, protected. Just put it in a splint or something. But if we get that huge blow-off day, you should look at that and go, okay, that was people just dumping. And that's what we need. We need people to just dump. And I think this week has been the start of that. We'll see. The panic and the people finally, people who said that the coronavirus wasn't a big deal, people who criticized me in those early articles I wrote, I don't hear from them anymore. And they're not criticizing me anymore. So I think you need to be real careful. And I'm not looking for a V-shaped recovery here. I'm just telling you that once we get so cheap that You can't really expect it to get much cheaper. You have to hold your nose and buy. And you can't buy the S&P 500 because that's going to be more like a U-shaped recovery. It'll take a very long time. A lot of companies got to get kicked out of the S&P 500. But if you have QQQ and ARK and semiconductors and gold, right, and solar, you'd probably be in pretty good shape. The asset allocation there should be about half of your investable money in QQQ and half spread about evenly across the other 4 ETFs. You want to be heavily weighted to the blue chips because there's greater risk in those other sectors. We will end up trading the gold and the solar and the semiconductors, right? And we'll let Kathy Wood over at ARK Investments trade that portion for us. So about 3/8 of the portfolio will trade based on the weekly chart. And when it gets overbought, we'll trim it way back. And when it gets oversold, we'll add right back to it. But the QQQ is really going to be our core. We can probably trim that here and there over the next, decade. But in general, you want to be in those companies, except when we think the market is really overvalued. Because we saw that overvalued can become more overvalued, can become more overvalued. All the charts that I've put into these articles should show you that pretty easily. In the match article, I laid out all the valuations, and we saw how overvalued the market was before the crash. We'll have a new chart soon, and it'll be back down in here. The market's not undervalued yet, by the way. It's roughly fairly valued for next year's earnings, not this year's earnings. This year's earnings are going to crash. And I put this chart up a month ago, right? What does it say about corporate profits when low interest rates close to zero don't help them go up much anymore? We need big structural change in the economy. And unfortunately, you can't have that change because it's very demographically driven. You have technology and you have debt that you can impact. Technology will be good for the economy over time, but really, we have to devalue the debt. And if they do it right, it'll work. 2 years ago, I gave an interview titled "Helicopter Money is Inevitable." And now you hear people like Neil Kashkarian, Ray Dalio, who runs the biggest hedge fund in the world, who's a billionaire, JP Morgan's CEO, Jamie Dimon, and now people in Congress are talking about just sending out money. We're going to get more of that in the next decade. And that's one of the big reasons why I think the gold stocks are going to do very, very well. Gold is at a point now where if it doesn't go below this level, if it stays above this blue line, right, if it doesn't go below it for multiple weeks, stays above this blue line, tests here probably take off. Now, if it goes through, it means that we're having a deflationary event and we didn't respond to it well. It could come all the way back down to around 1,000, 1,100 on gold. And then the gold stocks don't do so well. But if it holds this and takes off, then these gold miners are probably going to break out of here. It's been testing the upper band, right? Got up here, pulled back, got up here, pulled back. If it shoots up, right, if it doesn't stay below here for too long, right, still above, and it breaks through, it'll take off. And I think this is just a matter of time. Is it going to happen this year? I don't know, but soon. For those of you who are new on the call, one of the reasons that I think everything works out, and people who listen to me know that I think that President Trump has made some tactical errors. I've been learning to be more diplomatic as I got older. I turned 50 recently. That with a new Democratic president, we'd probably go back to policies that at least were neutral for the economy. We'll see if they're positive, but I am hopeful that they will be, because I think that Elizabeth Warren is having a pretty strong effect on the whole structural argument, and Bernie, despite being Bernie, with some of his quirks, makes some good points. I think we're going to see better healthcare in the future. That's good for the economy. Remember, if there's base coverage for everybody, if it's easy to get coverage and cheap to get coverage, that means that entrepreneurs can go out and be entrepreneurs and open small businesses. That means that big corporations don't have to screw around with all the HR problems that come with changing insurance premiums. They can just provide supplemental benefits. So we're going to see some big changes. Why am I so sure that President Trump is going to lose, and have been for a while? I've seen the data of the private polling that the very rich do. The very rich have been doing polling on presidential elections since back to Kennedy, and they've never, ever gotten a presidential election wrong. They were the ones that were doing all the stock buying the week before Trump won, and why the market took off right after that. They got that one right. They got them all right. Every single one going back to 1960. And they not only have President Trump losing in the fall, they kind of have him losing by a lot. By about 10%. That would be a massive landslide as far as presidential elections go. There's not really a threading the needle thing that he can do this time. And if he does, it literally would be a 1 in a million thing. So that means that the year-end sell-off that I saw coming appears to have already happened because of coronavirus. Now, could it double dip? Sure. But who among the rich still has embedded capital gains? I mean, there's some big legacy assets, people who've owned businesses for 30, 40 years. But as far as the paper profits from the stock market and the real estate markets, if you've been paying attention, if you read Institutional Investor, or at least the things that I've thrown out there, you know that the wealthy have been selling into the market for well over a year. The next time the family offices report to Institutional Investor magazine what their asset allocation is, I can almost guarantee you that it's way less in stock. And then 3 months down the road, it's going to be way more in stock. So we're at the juncture now where you're going to need to be a buyer very soon. In October, November, December, January, February, I told you to be a seller. And just 1 month later, I'm telling you to be a buyer. Not right this second, but soon. We're looking for the last couple of signals. So you want to be in the newer parts of the economy, the growing parts of the economy, the parts of the economy with good balance sheets, secular growth, and either create technology or know how to use it. A lot of industries that don't create technology, but they know how to use it. I've talked about Delta Airlines and Ford, two companies that are just beat the heck right now. But they have some of the best technology in the world. And if there ends up being a bailout, what do you think happens next? Those stocks probably double. Now, I don't know if they're going to double from 5 and 20 or if they're going to double from 2 and 10. But those are companies that are on our short list of stocks to buy. And we have other companies, those are two of the riskiest ones. And, Delta and Boeing are on suspension right now. We're not buying them, even though they're way below our bottom fishing prices. For those companies, this is a financial crisis. Again, we'll find out in about the next week or so if the financial crisis is going to spread. I don't think it will, but we don't know that yet. So we have to wait and see. If the financial crisis spreads and you just keep sitting on your cash until somebody wakes up in Congress and says, we probably should do another $1 trillion. Because trillion here, trillion there, eventually it's real money, right? So That's gold. If you're not sure, if you worry about these lines, the bottom lines getting busted, then only buy a little bit. And then once it starts going up, then add back in. Add the rest. One little thing about oil. Don't fall into the value trap of oil. Half of the industry is going to be bankrupt by the end of the year. Okay, I'll repeat myself. Half of the oil industry, the oil producers, are going to be bankrupt by the end of the year. They're not getting a bailout. Pelosi won't allow it. We've done this screen before. I'll point you to the right end. New institutions buy-in. Look at those numbers. And then look at the institutions that sold out. It's from a month ago. If you ever needed an explanation as to why oil stocks weren't going up when they became profitable a year ago, here's your answer. The institutions won't buy them. And the millennials won't buy them anyway. Right? Companies like Exxon and Chevron are going to have major restructurings. Exxon probably goes to $10 a share at some point. Chevron, if they're smart, will spin off some pieces. Maybe they allow Exxon to participate in the deals and they spin off some pieces together. Pipelines, create a new pipeline company, create a new refinery company. So we'll see what happens there. But when you take a look at the Altman Z-scores, any Altman Z-score under 2 is suspect. See any Altman Z-scores over 2? No, there you go. Pioneer. Which company was the one that I said was if you're going to own a shale stock, the only one to own is Pioneer? I don't own them right now. I have some calls on them. I hope that they come roaring back. Chevron, again, they're in better shape than Exxon, but they still have major liabilities. Some of the majors, like I said, these Altman Z-scores mean that they can restructure, but they won't make it the way they are. And the best one, in my opinion, is Total, because they have the huge alternative energy holdings already. So what everybody talks about Chevron and Exxon and BP doing in the future, Total's already doing. They're way ahead of them. Huge first mover advantage. So you can certainly trade oil. I wrote this a year ago, but oil investing is dead. Don't buy Exxon. I'm telling you, it's doomed. Just like I said a few years ago that the oil drillers were doomed. 4 or 5 years ago, I said the oil drillers were doomed. I said this 3.5 years ago. I said this. Read the comments on this. 486 comments. How many people tell me I'm out of my mind? The 2 companies I focused on, right, were Transocean, who everybody thought was the best, and Seadrill, who everybody thought was second best. Seadrill's gone bankrupt, and Transocean where's my chart on Transocean? Rig, where's a rig? There we go. Let's take a look at this chart on Transocean. 5 years. Look at that. It's $1.11. It's down 95%. I'd say that's doomed. XLE is basically the oil majors and the major refineries and service companies, and it's basically at an all-time low. Theoretically, you could trade this for a bounce, but it's never getting back up here, ever. In fact, I don't think it ever goes above 40 again. This level right here, and it might not get above here. 35. 35 to 40 is the best it can do. And I don't think it'll do that well. XOP, I will tell you right now, this ETF won't exist in a year or two. It's just not going to exist. So many of these companies are going bankrupt that are in XOP. Companies on this list, they're just toast. I think the Pioneer might end up owning Parsley. We'll see. Because they're both Permian companies. So this would be one that you could speculate on too, would be Parsley, because it's Permian only. And the reason that's important is because the shale plays in most of the rest of the country, they aren't going to make it. All right, I'm going to let you go here for tonight. If you'd like to join the service, I encourage you to join the service. I will answer a lot more questions on Friday morning, but I do want to get out of here. I've been up since 5 in the morning, and I need to play with my dog a little bit. But please read the articles. Prepare to be buyers again. The world will get better, but the world will get better faster in certain parts of the market than others. Make sense? Have a great night, and I will get this posted in the morning. Take a free trial if you want all the limits.